Welcome to This Explainer. Today, we're completely dismantling that amateur trading mindset and handing you a highly disciplined, professional playbook. Look, speaking as a professional trader myself, I can tell you right now that the difference between making a living in this market and losing your shirt, well, it all comes down to what you do before the opening bell even rings. It's a pretty staggering reality, honestly. I've literally seen people dump $100,000 into a stock with less research than they'd spend researching an $800 flat screen TV. I know, right? The ease of just opening a brokerage account on your phone gives this false impression that trading is simple. But let me be clear. Relying on a hot tip from a friend or just hoping a stock goes up without putting in the time, that is a guaranteed way to lose your capital. Before executing anything in the market, you absolutely need a well-thought-out plan of action. We're talking about serious business here, with real money on the line. So here's our playbook for today. We'll cover the professional trading plan, playing offense by spotting winning stocks, the concept of tennis balls versus eggs, playing defense with your contingency plan, identifying trade violations, and finally, mastering your trading psychology. Okay, let's jump right into Section 1, the professional trading plan. I really want you to start treating every trade exactly like catching a scheduled morning commuter train. Think about it. If you take the 6:05 train every single day, and one morning it's just not there by 7:30, you don't sit on the bench all day hoping and wishing, right? No. You realize something is fundamentally wrong and you find another way to get to work. Well, your stock trades need to operate on that exact same principle. You should actually expect a profit on a schedule. If it doesn't arrive on time, don't just sit on dead money. You exit. As a professional, when I enter a trade, my priorities have a strict, non-negotiable order. Step 1 is always limit your loss. You must define exactly how much you're willing to risk and set a hard stop loss before you even hit buy. Step 2, you protect your line. Once the stock actually moves up and you've got a decent little profit, you move your stop up near your break-even point. And finally, Step 3, protect your profit. Do not let good-sized gains just slip away from you. Use a trailing stop to lock those in. Let's actually map those priorities out on a chart to make it concrete. Right down there at the bottom, point A, that's your absolute risk limit. That's where you ruthlessly cut the loss if the trade fails. Now, as the price climbs up to point B, your priority completely shifts to protecting that break-even line. And as it pushes even higher to point C, you're strictly in profit protection mode, trailing that stop up. Memorizing this specific risk management flow is absolutely crucial because it allows you to make instant, totally unbiased decisions when you're under fire in the live market. Moving on to Section 2, offense, spotting winning stocks. So the key to playing offense is figuring out if a breakout is driven by real institutional money or if it's just random retail noise. What we're really looking for are breakouts with persistent, multiple days of follow-through on significantly increased volume. Take a look at this 2013 Yelp breakout. You can clearly see massive volume spikes right alongside days of strong upward price action. Guys, that is the unmistakable footprint of big Wall Street institutions quietly accumulating a massive position. Retail traders like us, we just can't generate that kind of volume. Only the big money can do that. To consistently spot these massive multi-day moves, we can use something called the MVP indicator. This was pioneered by investing champion David Ryan, and it stands for momentum, volume, and price. Basically, we're looking for extreme institutional demand. For momentum, we want the stock to be up 12 out of 15 days. For volume, we want to see the trading volume jump by 25% or more during that exact same period. And for price, the stock needs to shoot up 20% or more during those 15 days. It's a high bar, for sure, but that's exactly the point. And I'll tell you, this MVP indicator is incredibly powerful in practice. Just look at this classic example from 2004. Google triggered these exact characteristics right after its buy point, running up 7 days in a row on just massive volume. A stock doing this is showing such persistent, aggressive institutional buying that the orders simply cannot be filled in a single day. The big players are forced to buy over days or weeks. This specific MVP setup actually kicked off a mind-blowing 625% run. That is the kind of offense we want to play. Next up, Section 3, tennis balls versus eggs. The legendary fund manager William B. Berger used a phrase that pretty much every pro trader lives by. I want to own tennis balls, not eggs. It's a great analogy. Healthy stocks act exactly like tennis balls. They experience these brief, healthy 2 to 5 day pullbacks on really light volume, and then they snap right back up to new highs. Failing stocks, on the other hand, are eggs. They suffer these heavy volume sell-offs, drop off a cliff, go splat, and totally fail to recover. You do not want to be holding eggs. This 2009 Netflix run perfectly demonstrates that classic tennis ball action. Notice those brief, quiet pullbacks of just 5 and 7 days. The volume completely dries up during the pullback, right? And then it just expands powerfully as the stock shoots back to new highs. A stock under strong institutional accumulation is going to easily find support during its first few natural reactions. So, when your stock is bouncing like a tennis ball, your plan tells you to sit tight and hold. All right, Section 4. Defense, your contingency plan. Look, amateurs hope for the best, but professionals, we plan for the worst. Your contingency playbook has to be fully mapped out in advance. You need a pre-established initial stop loss before your finger even clicks buy. You also need predefined re-entry criteria, just so you don't miss the real run if you happen to get shaken out early. You need distinct, separate strategies for selling into strength versus selling into weakness. And crucially, don't skip this, a disaster plan. Seriously, if your broker's system just crashes, do you have a backup account or a direct phone number to the trading desk to exit instantly? As professionals, we do. All this preparation creates a massive psychological gap when a stop loss is actually hit. Amateurs feel burned, they take it personally, get emotional, and basically swear off the stock forever. Professionals are totally different. We're cold, we're objective, we protect our capital, take the small paper cut without flinching, and immediately evaluate the stock for a new re-entry opportunity. Believe it or not, very often a stock's second setup turns out to be way more explosive than the first. You have to stay objective to catch it. This brings us to Section 5, identifying trade violations. We call these early warning signs violations. Basically, if you buy a breakout, you expect the stock to behave. If it starts breaking out on low volume, but reversing and falling back on high volume, or if it's printing 3 or 4 consecutive lower lows without any big institutional buyers stepping in to support it, your probability of success is collapsing right in front of you. And one of the absolutely most severe violations you can see is watching a stock close below its 20-day or 50-day moving average on heavy volume shortly after it breaks out. Just look at the total devastation in lumber liquidators here. It broke out on weak volume, completely failed to follow through, and then just shattered its 20-day and 50-day moving averages on massive, institutional-size selling volume. When professional traders see this kind of glaring red flag, we don't cross our fingers and pray for a miracle. No way. We execute our plan and we exit instantly. Capital preservation is everything. However, good defense definitely requires some nuance. Take a look at Micron here. Sometimes a stock breaks out, but then kind of falls back into its daily range to close near the bottom, what we call a squat. Now, if it squats, but it doesn't trigger your hard stop loss and it doesn't show any of those major volume violations we just talked about, give it a little breathing room. Case in point, just 2 days later, Micron staged a really healthy reversal recovery and went on to gain an incredible 87%. You want to trade with tight risk for sure, but don't choke your trade to death before it has a chance to work. And our final section today, Section 6, Mastering Your Trading Psychology. This is where the rubber meets the road. Without a rigid, objective rulebook, you will inevitably become trapped in what's known as the paralysis regret cycle. First, you face indecisiveness right at the moment of action. You're agonizing over whether to buy, sell, or hold, totally paralyzed by the fear of being wrong. And then you are just tortured by regret, endlessly repeating, I should have bought, or I should have sold. Guys, this emotional roller coaster will completely drain your mental capital, and it will eventually sabotage your entire account. As a professional, you execute your plan, you evaluate the results, and you troubleshoot without fear or greed dictating your moves. So I'm going to leave you with this question to really think about. Are you going to continue letting the exhausting amateur cycle of indecisiveness and regret drain your account? Or are you finally ready to step up, put in the actual work, and trade with a professional plan? The market is out there, and it's waiting for your answer.